I could imagine. Hey guys, hope everything is going well. Today we have a returning guest of he's been on many of my channels regarding sports cars, regarding gold, silver, stocks, etc. And John, thanks for coming on again. How's it going?
Thank you. Yeah, thank you for having me. It's an honor to be on this show.
Yeah, so where, first of all, before I begin, where can people find your work? I know you do a sports channel now, so if people are interested, where can they find you?
Yeah, generally it's the J22 Report or J22 Report Sports and Entertainment. I haven't been able to do videos because of work obligations and whatnot. Hopefully, I can start doing them again. But this year has been just hectic for me.
Okay, okay. Sounds good, sounds good. Okay, so earlier this year, I remember we had some text messages going back and forth, and you were saying that, hey, just like Gerald Salente was saying, the Federal Reserve is going to raise rates to try to curb inflation, but then something is going to go wrong, and then they're going to have to reverse course. So, can you explain your thought process? What you're telling me earlier this year that some of the audience didn't hear you say?
Yeah, so on my channel when I was doing it, I actually the economic data looked horrible. It still looks bad now. The leading economic indicators declined more than expected recently. If you look at the retail sales for November, and you have to remember there's Black Friday. This is part of the shopping season, and it's still declined by 6% in the month of November. A lot of the service sector index, which service sector is 70% of our economy, whereas the S&P 500 service index or the ISM service index, a lot of that's in contraction now. And so the last two quarters, I mean, the first two quarters this year being in negative does not surprise me. And if you ask me, we are in recession, but they're using the economic the job numbers, which are probably the most manipulated thing in the economic data to justify that we're not in recession. But if you look at all the other data, it's horrible. And quarter three, the only reason we had positive GDP is we took oil from the strategic petroleum reserves and sold it to uh, most of Europe, and we counted that as exports. So it's not even things we're making or producing or services that we export. It's oil that we bought during basically the Trump presidency when it was $10 and we're just selling it now. And that's eventually now we're buying back oil. So I expect sometime next year, even though I think inflation will calm for the next couple of months, sometime next year with all that buying power into the oil market, that's going to leak over in the other products. I think that's going to cause inflation. Plus, China opening up will now create more demand. So, but if you look at it, do the interest rates, uh, and a lot of layoffs, Silicon Valley especially, the economic data, and people are not spending because of inflation. They're no longer buying stuff they don't need. They have to spend all their money on food and energy. So that's what I was seeing. All the non-job numbers, economic data was showing it. If you follow it.
Yeah, so we're looking at the Fed funds rate right now at what, four and a quarter, I believe, or somewhere around there. And I believe that if they continue to raise interest rates further, I mean, as they did this year, then that would collapse the whole system. So I expect maybe you could see maybe a 50 basis point move and then another 25 basis point move, but then otherwise they're going to pause. That's how I see it. Do you see it that way?
Yeah, I definitely see it. I remember you talking on your show on because I'm not just a guest, I'm a listener. Uh, yeah, but they're slowing the rate of increases, which to me they're now trying to pivot to eventually a reverse course, but it's going to be done over time. So they don't want to make it look like an emergency when they pivot. So I think they're sort of anticipating, like they look at the same data I am. So despite the PR of the Fed and the government administration, they see it. They know there's eventually going to be a point where they can't hide it, and it might even show up in the jobs numbers. But yeah, that's what basically what I'm saying. It might show up in the job numbers, but eventually they're not going to be able to hide that we're in recession, and they want to reverse course right now. So I'm surprised they didn't wait for oil to fall further to rebuy back from the strategic petroleum reserves. I wonder if the reserves are much lower than what we're told.
Yeah, let me share my screen and then show people what the Federal Reserve may be doing. I don't know if people can see it. Can you see the Fed
I can
funds
see the
futures?
screen.
You can see the screen.
Yeah.
All right. All right. So the Fed funds futures over here. This is where the sophisticated money is betting on the Fed funds rate. And what you need to do is you need to take 100 minus this. So if you want to look at January, so 100 minus 95.665. And that's what a little more than 4.25. So 4.35% or 3%, whatever it is, right? And if you go further out to February, it's another 25 basis points move. So you're
Mhm.
looking close to what, 4.75%? It's 4.65% almost. And then if you go all the way to June, it seems that May and June, it seems that the Federal Reserve is going to stop based on what the market participants are looking at. So it's like 100 minus 95.09, so close to 5%. And then you see months ahead where then you see potential rate cuts, like 100 minus 95.25, that's what, 4.75. So it looks like as early as middle of the year, all these rates, I mean, as early as April or May, they're going to stop doing this. So I just find that quite interesting that that's what the sophisticated money is looking at. So it is what it is. I think that's going to be bullish for asset classes all over. Do you agree with that?
Yeah, that's sort of like my sort of cycles work. I think it's going to be interesting because I think we'll be in recession next year officially. I still think if we actually use the old numbers, meaning two negative quarters of GDP in a row, then that what we are in recession, and you don't based on the old numbers, you don't get out until you have two positive quarters. So even if we have a positive quarter in quarter four, which I don't think we are, but we could. It's possible. But I think we'll be in a full blown recession. I think we'll be in at least some sort of recession because in order to justify rate cuts, they need fear in the common people. And right now, the whole story is inflation. That's what most people are talking about. I even see people on LinkedIn talking about inflation and how employers need to pay up their raises more because if you jump jobs, you get a 15 or 20% raise. So instead of staying with a company, it's better to try to job jump because with inflation, the 3 to 5% raise is just negative. So I think they need a fear of job loss in the average mind. So I think they'll keep raising rates, but they're slowing it down because they see how bad. And the other thing with home prices, it's still more expensive to buy a home because of the interest. So home prices have a lot of room to fall over the next year.
Yeah, I agree with that. I mean, you make a lot of good points about potential job loss. We've seen job loss right now going on in Silicon Valley, in the real estate sector, in crypto. So I expect this to potentially continue until the Federal Reserve puts a halt and then eventually things will start to get back to normal in these markets. I think real estate, though, jumped up way too high. I mean, you may see the high end pick up sometime next year, but at the same time, I expect still more trouble in various parts of the economy. Now, I wanted to segue into a different topic that we're most familiar with, and it's gold and silver. So, what are your thoughts about these markets right now?
For now, I think gold has sort of bottomed, meaning it could go back down to 1650 and retest. I think with this very high interest rate environment, that gold survived it. So I don't think we'll see a repeat of 2013. And the other reason I think we won't see a repeat is I think this 6 to 7% inflation is here to stay, because it's not just monetary anymore. We have really bad supply chain disruption and just bad policy. And for the next couple of years, I don't see any of that reversing course. I don't see that I'm doing basically what needs to be done. And your audience probably already knows, so there's no point in belaboring about what the policies are. So yeah, a lot of it is also just yeah, the supply chain, which I don't see that getting fixed. I don't think they're that serious about it. Even when I go to the store, some things that I get normally, like certain coffee flavors. Every time I go to the store, I'll just buy it because I don't. If I run out, I just don't know if it's going to be there by the time I run out. So if there's some things that last a long time, I'll just buy them when I'm at the store, just because I just don't know when they're gonna be there. One time I had hazelnut coffee on for 6 months at the grocery store I stopped. It actually just came in, so it's not just monetary; it's supply chain. So I think high inflation's here to stay, and I think that's put a floor from 2013 repeating. You were talking about the tips and how they don't see much higher inflation, which is good because that means it has room to run. But I think what needs to happen for gold to really make the move of going to 2,500 to 3,000 is I think there needs to be a fear in the economy and a decline in the stock market. And the stock market's not doing well this year, which I don't think it will continue to do well because these companies' financials are horrible, and the higher interest rates are preventing a lot of buybacks. People don't realize the reason QE and 0% interest rates drove up the stock market is because they can borrow at zero and then just buy back stocks. And because they borrowed at zero, it cost them nothing. So they borrow at zero, they buy back stocks. And then the other thing was CEO movement. CEOs stayed around for 4 to 5 years. They borrow at zero. They had all their incentives and stock options. So they start buying back the stocks and be much higher by the time they retire and they cash out. So that's sort of why. And I don't see that happening. I don't see a record amount of CEOs retired in 2019. I don't see too much turnover at the top, and I don't see too much and with this high interest rate. So I think this decline and scare in the stock market is going to be good. And I think Bitcoin, the counterparty risk is going to be good because a lot of people are going to be scared out of Bitcoin for good. So I think gold will do well, but this year might be another transition year. I thought last year was going to do well. It didn't really do that well. I didn't think the Fed would be as aggressive. I thought with the recession talk, but I think the bottom is in.
Yeah, I think you're talking about the 10-year tips, which I always talk about. And let me share my screen again to show the audience what I was looking at. And I think this is probably the most important yield. Can you see this?
Yeah, I can see it.
All right. So remember, I think it was like 2018. Didn't like gold start another rally at that point, late 2018, 2019, and then
Yeah,
We,
2019 definitely. I remember.
yeah, there was a rally in gold, and then I remember the pandemic, and there was a time where gold took a dip, and then it then resumed to the upside. And you
Hmm.
see, like positive rates in 2019, like was like 1 point over 1%, right? And then it
Hmm.
kept on going down. There was a dip here 2020, then went down, and then you saw a rally. And then all of a sudden, like there was the Ukraine situation, and you had the Ukraine Russia situation. You had a rally, and then all of a sudden, we had a rally here. I'm not a rally. We saw tips go up, and then gold prices took a dip. So it's just quite interesting, and I expect these tip yields to go lower, in my opinion. So yeah, I think a 10-year tips has a lot to do with gold and silver, and also if you look at the 5-year tips, similar pattern. So I expect these markets to rally here. So now, in regards to the silver premiums, I remember in what 2015, 2016, or maybe like 2014, I was paying $5 over spot for Silver Eagles. Now it's what for 2022 Silver Eagles, you have to pay what $18 over spot for one
Yeah.
Silver Eagle, and then you have to pay shipping from these companies. Now you can go on eBay. I understand that, but still, like, what's going on here? This just seems, like I say on my sports card channel, some hanky panky.
Oh yeah, just all you have to do is go look at the buyback prices. I'll just use the best example, what we went for, because that's the most recent JM Bullion. $6 buybacks. You buy it for around $30 or $31 a coin, and then if you sell it back to them, it's around $24 a coin. And so they're probably buying. So if you sell your coins back right now, they turn around and sell them. That's a $6 profit, $600 profit. That was always unheard of. I remember my company when we used to work on any of those type of sales, the margin was $100 to $150 per $100 sale. Now it depends on how much you bought back. You sold to us, like any industry, bigger orders, better deals. But a $600 profit for $100 trade, because a lot of companies, this is what people don't realize, they rarely hold inventory. Peter Schiff, the only reason I'm commenting on Peter Schiff is he said this publicly a couple of years ago. They don't hold inventory. A lot of companies they deal with direct suppliers. Sometimes they buy from each other too. That's another thing. So, but generally speaking, they buy from 3 or 4 wholesalers and they sell them to the retail sector. And a lot of them, and some of these wholesalers sell to the retail, they just sell to retail at a lot cheaper prices because, they don't buy from them every day. So it's like any industry. If you bought more volume, you get better deals. But $600 profit on the trade of 100 coins was just unheard of in my opinion. So, or basically when I used to work there. So there's definitely some, maybe they just decide to raise their margins and they just, because I don't know how many, I remember in 2013 and 14, sales of Silver Eagles from the mints were skyrocketing. And I don't hear any like, gold bug or gold, like Mike Maloney's or whatnot, talking about how much gold Eagles are being bought or how much silver Eagles are being bought. So yeah, they're definitely raising the prices in my opinion. I don't see any type of they're raising the profit margins, and I would say uh, I in my opinion I can't give financial advice. So just remember, all this is just financial conversation and not advice. But in the 2000s, these two coins, St. Gaudens Eagle and the $2.50 Indian, their premiums are now really low. But a lot of people bought them in the early 2000s, and then they would sell them based on the confiscation story. And then basically, some of these 2 coins just survived by chance. So they started marketing them as non confiscatable. And so everyone started buying them, but then the premium skyrocketed because so many people were financially devastated by buying those coins. Those coins are now toxic and the premiums are super low now. But those premiums were high for a long time. And I think something like this could be in the bullion industry. I don't know if it's due to low volume or people hate numismatics so much they're no longer buying numismatics, but it's not for the tightness of supply that they say. That's just not, there's so much above ground silver and so much above ground gold that supply's never really that.
Yeah, I mean, very, very good points here. I'm just still shocked at $18 over spot, to be honest. And I've never seen that as long as I've covered this industry. I think, probably when the supply chain gets better, I think it's probably a better time maybe to sell or just not buy if you're a silver bug or if you're thinking about investing in this sector or speculating. I believe, I can't tell people what to do. I think potentially the miners look like a decent buy for me. I think sometime early next year. I mean, if the dollar rallies a little bit, then I may, end up buying some silver shortly.
The full disclosure, a couple of weeks ago, I bought some miners. So I think the miners are pretty, I think the mining stocks are pretty undervalued right now, but I don't know. It could be undervalued for one more year. The thing about gold, what I think needs to happen is fear in the economy and a declining stock market, which we're getting. I think year over year, the stock market is not uh, positive. Am I right?
The stock market has gone down, like what, 4,800 at the top. I don't know like what it was in January, to be honest.
Yeah, let me see. I'm just gonna try. I'm gonna go to Yahoo Finance. I'll just look for year to date. Yeah, the S&P 500 in the beginning of the year was around 4,600, and so now it's 3,800. So that's quite a decline. So I think we're eventually going to see and when I mean a rally, like technically it's rallied from 2015 to 2000 till now, but most of those gains came in one rally from 2016, which was 6 months, another one in 2019, which was 6 months, and then the brief rally came. So even though it's made a new high, it hasn't stayed there. But I think over the next year or so, a multi-year bull market's coming, and it will be because of a declining stock market. And a lot of these companies are going to get hit hard with financial risk. And I think Bitcoin declining is also going to, and people losing their shirts in Bitcoin is also going to people to go back to gold because they're starting to realize Americans have been spoiled for the last 30 years on this, but anytime you invest, there is counterparty risk. And it's not just Bitcoin, but when you put money in a bank, there's counterparty risk. So you're always going to have that. And I would say Americans in general have been spoiled since I would say the 1980s or even post World War II, where they didn't have to worry too much about banks going under or whatnot. So these mining companies, and you have to be a quick learner. Like me and you were a quick learner about Mount Cox, so we sort of stayed away from Bitcoin. Now, I wish obviously, I wish I bought in it, but well, I wish I bought in, but the reality is counterparty risk is a big thing, and that's going to be something people have to be aware of in the future, not just with Bitcoin, but stocks, brokerage houses, and what's it called again? Banks. So Always have, my opinion, always have some physical, because when there's bad counterparty risk, your physical at least go up.
Yeah, indeed, indeed. I'll end this for now, and we'll my Zoom's gonna end, so
All right.
we'll just continue on after this.